So it's mergers and acquisitions, and we have said here the best way of remembering what a merger is, ladies and gentlemen, is to recall that if company A and B are to come together through a merger, then both of them must go to the registrar of companies to have their names struck off the register of companies. So the two companies here must lose their identities to give room for a completely new company called C to be born. And then we have an acquisition. For acquisition, if A acquires B, no, first of all, let me go back here. So we've said for mergers, ladies and gentlemen, if A and B merge, if they come together, automatically, ladies and gentlemen, in form of a merger, then these two companies here will lose their identities, so that at the end of the day, we shall have a new company being born. So if we're asked to define what a merger is, never forget that a merger basically is the coming of two or more companies together. So whenever we have two or more companies coming together to form one new company, that becomes a merger. And then don't forget that the old companies must lose their what here? Their identities, must lose their identities. And then when we have A acquiring, for instance, B, if A acquires B, the company that has been acquired will have to lose its identity. And then at the end of the day, the acquirer firm, the acquiring firm will, of course, in this case here remain, albeit in a bigger way, because it has swallowed a company. It has taken over assets of another company. Could you kindly give me examples, ladies and gentlemen, of companies that you know have ever come together through mergers in Kenya? Could you kindly give me good examples of companies that you know have ever come together to form a completely new company in Kenya here through mergers? So please give me the names of the two companies, the names of the two old companies that came together to give us a new company. Is there somebody who can remind us? So like now we have a 𝐂𝐿-𝐶𝐵𝐿. 𝐂𝐿-𝐶𝐵𝐿. We have a NIC Bank. NIC Bank, in this case here, combined efforts with which bank? CBA. To form which bank here, somebody? To form a brand new bank called who? NCBA. And if you are a student who follows finance news, you must have seen the struggle that NIC, that CBA went through in terms of informing creditors. They used to buy full newspapers, full-page newspapers, saying, hey, our creditors, we are going to, in this case here, put down our tools. We are winding up this company. Why are we winding it up? It's because we want to combine efforts with CBA, right? To form a new company called what here, NCBA, so that we can, for example, in this case here, muzzle up some good financials here to be able to fight competition, right? How about this one here? Is there somebody who is quite aware of any company in Kenya here that keeps on acquiring other companies? Is there somebody who knows of a company that, in this case here, is in the process of always acquiring other companies, smaller companies, and then at the end of the day, it keeps on becoming bigger and bigger and bigger and bigger, right? Like KCB has acquired National Bank. Brookside has been acquiring so many other smaller firms. And in my last class, if I can remember very well, I gave you a very good example that nobody in this case here was able to get correctly. Assuming that these two are great companies that want to come together. When they come together, these two, will this coming together of these two companies be classified as an acquisition or as a merger? Cat and rat, animal companies. Will it be an acquisition or a merger? I can see some students saying that this Mwalimu will be a very good example of a merger. I can see other students saying, Mwalimu, you know what? This is a very good example of an acquisition. The students who are telling us that this for sure is an acquisition, could you kindly, in this case here, tell us, why are you saying that this is an acquisition? Why are you telling us that this is an acquisition? It's because of what Mr. Guga has told us. There is one of these animals that will be absorbed permanently. One of these animals, ladies and gentlemen, here will be eaten up. So that at the end of the day, it is, as somebody is telling me there, it is the cat that will be able to prevail. It is the cat that will be able to prevail, albeit in a bigger form, well fed up cat. So this becomes what here, somebody, an acquisition. The cat has acquired the rat. The cat has acquired the rat. Now, as a quick reminder, I should be able to use my first 20 minutes here to basically do a recap. We discussed very, very important things in our last class, ladies and gentlemen, apart from this. For instance, if I can recall, if my memory is still as good as a 5-year-old's memory, I taught you something to do with what we called maximum exchange ratio. I taught you various formulas that I would want all the new students here to really go and watch that video of the last class talking about this. So is there somebody who can, as a quick way of recapping, is there somebody who can give me the formula of calculating the maximum exchange ratio? Is there somebody who can give me this formula? Maximum exchange ratio. Somebody have to talk to me. A recap really means that the two of us must connect. If you're not able to connect, then automatically we have a problem. And please, when you are doing a recap, you don't look at your notes. No. Just try to box your memories a little bit. Try to really put in some energies to remember, even if you don't get it, so what? So long as you're trying. They are telling me, Mwalimu, this is quite an easy one. This is quite an easy one. They're telling me, Mwalimu, this one, you shall take the earnings per share of the target company, all over EPS of a company that we call the predator, the one that will swallow the other one. Thank you so much. You guys are bright. Then there is something else that I also taught you that I would want to see whether you're able to remember in the next 5 minutes. In the next 5 minutes, I taught you something to do with a premium being received by shareholders of the target company. Is there somebody who can remember the formula of getting premium without looking at your notes? Please be very faithful in whatever that we are doing. We must learn how to be faithful. I'm training accountants, and the first virtue of an accountant is honesty. Don't look at your notes. Try to trouble yourself, in this case, to remember. Premium equals who? MPS of the predator minus something. I really love that. This must be a good student, although mekosea kiasi. First of all, it can't be MPS of the predator, but at least you have something. That is the kind of student I want. Offer price minus MPS of the target. Glad is quite a good trial, but don't you think? Let's see. The last student, somebody who is able to remember this. In the interest of time, ladies and gentlemen, remember this premium comes as a result of who? We have here the shareholders of the target company. The shareholders of the target company, for them to think of an acquisition, it means that straight away they have financial problems. And for them to get out of these financial problems, they must think of selling the company. And for them to sell the company, ladies and gentlemen, there are two ways. Either they sell their shares to the predator through an acquisition, so they are acquired, or in this case here, they go to the stock exchange and they sell their shares. They go to the stock exchange, which is an exchange of selling shares. Basically, this is a market of shares. So they go to the market and they'll be able to get the MPS. Now, in most cases, of course, for the predator to be able to convince these people here to sell their shares to them, they must offer a higher price. So you're saying that the acquirer must always offer a higher price. So for us to be able to get this premium, listen, for us to be able to get this premium, we shall be taking the offer price, the price which has been offered. It could be the non-diluting offer price, then though, or whichever, or the normal one. So we'll take the offer price. What has been offered must be higher, minus the normal price they would have fetched in the market, minus the normal price they would have fetched in the market, minus the normal price they would have fetched in the market. This is the MPS of the targeted company, the MPS of the targeted company, the MPS of the targeted who company, MPS of the targeted company, MPS of the targeted company, MPS of the targeted company. These are things we shall be able to remember. We shall be able to remember, especially when we have a look at the videos that are done in the last class, which of course, someone told me that they are not very well organized. I'll look at them after this. I'll look at them after this. Now listen, lastly, there is something very important here that I taught you in my last class called the post-acquisition EPS. Is there anybody who can remind us the formula of post-acquisition EPS? Is there anybody who is able to remind us the formula of post-acquisition EPS? The students who have just joined us, we are doing what we call mergers and acquisitions. And I'm basically doing a recap. So when we talk of post-acquisition EPS, post-acquisition, I've acquired this great lady to be my wife. We have combined forces here to create a family, a new family. So it means that our earnings must be tied together. So you take the earnings of the husband plus earnings of who? The wife. Post-acquisition EPS, post-marriage. We expect the two earnings to be put together. And if these two people here, this couple is a serious couple, they should even be able to put their earnings in the same joint account. With who? Having the full rights of accessing that joint account? The husband. The husband. Remember, we are the heads of the families. Heads of the families. Both. So we have here earnings of company one plus earnings of company two divided by the noses. Nose of company one plus nose of company what here? Nose, ladies and gentlemen, nose stands for number of ordinary shares. Because ordinarily, to get EPS, we normally take total earnings. Total earnings divided by what here? Somebody? Number of ordinary shares. Number of ordinary shares. So we'll take the total earnings of company one plus earnings of company two divided by the total number of shares. Remember, this number of shares here will not be inexistent. We must come, ladies and gentlemen, and multiply this with what here? Exchange what here? Exchange ratio. Exchange ratio. So this was quite a good recap. And this is quite common in your exams. I expect you guys to go and revisit this. And most importantly, please use the question that we did in our last class as quite a good illustration for you to practice. Otherwise, please mention there today's subtopic under mergers and acquisitions, quite a huge, interesting subtopic called valuation of firms. Valuation of firms in M&A. Valuation of firms in mergers and acquisitions. So there is no way we shall be able to get into a merger, to get into an acquisition arrangement without knowing the values of the firms. We must know this firm that we would want, ladies and gentlemen, to acquire, what is its worth. There are several methods. One of the methods which is quite common is what we call the discounted cash flow technique. The discounted cash flow technique. The discounted cash flow technique, where basically we shall be looking at this firm that would want to acquire, that you want to acquire today, RCM Online College. For you to acquire RCM Online College, you can't come to acquire RCM Online College from us blindly. You are a finance scholar. What you'll want to know, first of all, how have our cash flows been, perhaps for the last 7 years since we began. So year number 1, our cash flow was 10. Year number 2, our cash flow was 15. Year number 3, our cash flow, for example, was 20. So these, of course, those figures are in millions. You're not a small company, right? So ladies and gentlemen, the moment you are given these cash flows like that, so you're given, for example, we have year 1, year 2, year 3, year 4. So somebody comes and gives you cash flows over RCM. Cash flows over RCM. So they'll tell you cash flows over RCM. For example, year 1, our cash flow was 10. Year 2, for example, was 15. Year 3, for example, was 18. Year 4, for example, was 19. Now, remember what I taught you when we began this subject called finance. I told you that generally we have got how many types of cash flows? Two types of cash flows. So we have those cash flows that are regular, those cash flows that are uniform, where year number 1, you are given 10 million. Year number 2, 10 million. Year number 3, 10 million. Year number 4, 10 million. I can hear throughout those years, there is some uniformity. It's 10, 10, 10, 10, 10, 10. What is the name that we give to those cash flows in finance, which are uniformly receivable, uniformly, evenly, like that? There is a special name we call them. Robert tells me annuities. David tells me these are annuities. Thank you so much. Thank you so much. So this type of cash flows that we have here, ladies and gentlemen, do they fall into that category of annuities? Do they fall into that category of annuities? No. Why? Because I can see they are fluctuating. They are irregular. I like you guys. These figures are irregular. These are irregular. These are irregular. They are irregular. Year 1, I'm getting 10. Year 2, I'm getting a different amount. Year 3, I'm getting a different amount. Year 4, I'm getting a different amount. Now, ladies and gentlemen, listen and listen to me very carefully. If you gave me this as your cash flows over RCM, and I would really want to acquire this organization, it will be foolhardy. I'll be a foolish man to start adding these cash flows directly. Like I said, 10 plus 15 plus 18 plus 19, and then tell you the total. And then I tell you that this is what I'm projecting to receive in the future. You will be a fool. Why? Because in finance, a shilling today is not exactly equal to a shilling tomorrow. In finance, we believe in what we call corrosion of value as time lapses. During my days, ladies and gentlemen, if I can remember very well, my own mother could, in this case here, carry a very big bag, kikapu, very big, under sokoni. And I can remember vividly as if it was yesterday. In the early 80s, even mid 80s there, I can remember this, although I was a bit young, but I can remember this vividly as if it happened yesterday. With this kikapu, that great lady could go to the market with only 1 shilling, hivi shilling moja, and she would do good shopping. That kikapu would come, in this case here, back full, and trust you me, still, alikuwa na baki na mangotora, ile mapeni, ilikuwa mapeni na kara ingine fani hivi, mapeni. A shilling used to be very powerful. A shilling used to be very powerful. But right now, if I try giving my own son, even if my own son, for example, was to be a 3-year-old, it's not a 3-year-old, but I'm giving you an example. I give a son who is 3 years old, I give him 1 shilling. I'm so sure atarusha chini. Ataniambia isitaki. Why? Because now it has become worthless. So for us, there is no way we will ever add these currencies coming to us, cash inflows coming, even if they are outflows, there is no way we'll ever add them directly. We must recognize what we call time value of money. We must discount. So for me to discount, I would ask you to give me the cork. Give me the cork. The 𝐸𝐸 in this case, you will tell me, of course, you can tell me, for example, the 𝐸𝐸 is 10%. If you don't give me the 𝐸𝐸, I know how to estimate it. I'll get some financial news metrics from CBK and look at the average T-bill, treasury bill rate. The moment I get that average treasury bill rate, I'll be able to take that as my cost of capital. So I'll tell you, hey, I'll discount your figures using the average T-bill rate, right? So in this case here, I'm assuming that the cost of capital is provided, it is 10%. Now, there is one thing that you guys haven't given me. There is one thing you guys haven't given me. I'm not writing too low. Here, remember now I've finished. I'm not. Are you able to see this? Are you able to see this is cost of capital, 10%? Are you able to see the cost of capital is 10%? Or you're not seeing it totally? Ah, yes. If you're able to see it, then I'm not going to write any down again further. That's the end. That is it. That is it. Thank you very much for that reminder. Now, ladies and gentlemen, there is one thing you haven't told me. If for sure these are irregular cash flows, then you're telling me to discount. So to discount them, it's either I use PVIF or I use PVIFA. Two things. It is either I'll use PVIF or I use PVIFA. PVIF stands for present value interest factor. PVIF stands for present value interest factor. PVIFA stands for present value interest factor of an annuity. There is no way I will use this PVIFA because for sure these are not annuities. So you can see what some students are telling me there straight away in the text they're sending. They're telling me, Mwalimu, use PVIF. Don't use PVIFA because PVIFA is normally used when you have annuity cash flows. These are irregular. And if they're irregular, ladies and gentlemen, you're telling me, use PVIF. Easy said than done. So if it's PVIF, are you able to remember the formula? Are you able to remember the formula of PVIF? Is there somebody who can remember the formula of PVIF? Is there somebody who can remember somebody who is able to remind us these formulas very fast? We need to do what? To start rewarding them. We need to start rewarding them. We need to start rewarding them. Great. I can see what Susan Mwende has just told me. She has told me, Mwalimu, don't joke with us. The formula of PVIF is the easiest formula that we have in this world. The formula of PVIF is 1 plus R raised to negative N. The formula of PVIF is 1 plus R raised to negative N, where R is the rate of return, where R is the cost of capital, N is the year. N is the year. So that if that is the case, I'll come and create a column up here and call it PVIF formula, which is 1 plus R raised to negative N. And then I'll start right away hitting the road hard. And this is how I will hit the road hard. I'll talk of 1 plus, we have R, which is 0.1. Right? Raised to N. N is the number of years. This is the first year. This is the first year. So I raise this one here to negative 1. So ladies and gentlemen, could you kindly give me this one here? Raised to negative 1. What answer are you able to get? And I would want all of us really to use our calculators. Never copy my figure. My figures are always wrong. This semester, I'll always give you wrong figures. I'll only be taking figures from you guys. So somebody is telling me that upon raising this correctly, they're getting 0.9091. They're getting 0.9091. Thank you. Thank you so much. From there, we go to year number 2. Year number 2, I'll talk of 1.1 raised to N. This year is N is 2. I'm so sure hujaona nimetoa 1.1 wapi. Hujaona. I'm so sure there must be somebody hajaona nimetoa 1.1 wapi. Nimetoa 1.1 hapa, 1 plus R. Remember, my R, which is the cost of capital here, will not keep on fluctuating. My R is the same, is 10%. So 1 plus 10% is 1.1. What will keep on changing is the number of year 2. So then somebody tells me that this gives me 0.8264. Thank you so much. Please go to the third year. Please give me these figures. 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 So Jackie tells me the next one is 7513. 7513. The last one, according to 𝐿𝐿𝐼𝐶𝐬, no, 𝐿𝐿𝐼𝐶𝐬 has given me the same, which is very good. So 6830, 6830, 6830. Thank you so much. Thank you so much. Thank you so much. Now then, could you kindly do me a favor? Could you kindly do me a favor? Could you kindly do me a favor? Do we have discounting tables, all of us, on our tables? You know, the examiner in most cases will give you discounting tables. Do we have the discounting tables or any past paper? I told you for financial management, you must print those past papers from that link. You print all of them and then you carry them in a file. Please, for the sake of the students who may not be having that past paper which has got that particular table, could you kindly share those papers on our WhatsApp? Please share those papers on our WhatsApp. If you don't mind, please share very fast. And then you tell me shared. Share very fast. And then you tell me shared. And then remember, ladies and gentlemen, that in online classes, you need to be very aggressive, giving us answers through the chats. Very important. And if you don't have, for example, the paper, never shy away. Say, I don't have the paper. Never allow us in this case here to move to the next step if you don't have these things. It's good for you to ensure that you have all tools of trade. Otherwise, if you keep quiet, Zoom classes are dangerous, because I'll straight away make an assumption that these guys are understanding. And once I sense that guys are understanding, what do? I know that now I'm on a highway. Actually, it should be an expressway. Sorry. So shared. Thank you very much. So shared. I can see students who are asking whether Mwalimu, you'll be dictating notes. There are no notes here able to be dictated here. It's you to get the skill, really. It's you to do. It's you to do this. It's you don't know, you don't even going to write discounting. After all, I'm even required in this case here to assume that you guys are so good in this, right? Myself, my role here is to ensure that you have the proper skill, right? Because you can imagine, like now for discounting, if I start writing for you like PV, we'll never finish the syllabus. So mine will be to do this, and then I give you the video after this. So once you have the video now, later on, you can try to get something that is there. And of course, occasionally, I'll also be sharing with you handouts. Great. Now, if we have those tables, there are two types of tables there. The examiner will always give you two types of tables. There is one table called annuity. There is one table called annuity. Please look at those tables, two tables. There is one table called annuity. Is there somebody who is able to see that table called annuity? Is there somebody who is able to see the table called annuity there? They're saying yes. They're saying yes. They're saying yes. Now, ladies and gentlemen, are we going to make use of that annuity table here this time around? Are you going to make use of that annuity table this time around? No, because we are dealing with irregular cash flows. These are irregular cash flows. So if I'm not using the annuity table, I'll always go for the other table. So please go to the other table and go to where, in this table, go to where the examiner has given you a cost of capital of 10% up there. And then he has given you years here. He has given you years here. Right? He has given you years here, 1, 2, 3. Ladies and gentlemen, 10%, underneath 10%, year number 1. Year number 1. What are you able to see there, somebody? Underneath 10%. How I wish all these guys have these tables. Underneath 10%, underneath 10%, underneath 10%. What figures are you able to see underneath 10%? Year 1, 1991. 1991. How about now year 2? Year 2. How about year 2? How about year 2? How about year 2? 8264. 8264. How about year 3? How about year 3? How about year 3? 7513. 7513. And then we have the last one, which is year 4. Year 4, what are we able to see there, somebody? 6830. 0.6830. 0.6830. Like that. I can see Moteithia Gitonga raising his hand up. Moteithia, unfortunately, I cannot allow you to ask a question verbally. If you don't mind, Moteithia, if you don't mind, right, just type your question. Because if I try, in this case here, allowing you to unmute yourself, this thing is going to be messy here, right? It's going to be messy here. Please type. Now, all of us, please, if you guys are honest, all of us, have we been able to know how to read this from the tables? All of us, have we been able to know how to read this from the tables? Don't fear, this is your father. Yes, thank you very much. Yeah, thank you very much. Now, in an exam situation, which approach do you think will be better? Should we use the formula throughout or the table throughout? Formula or table throughout? Tables, of course. But that can only happen whenever the discounting rate is available. You know, you can see 10, 14, at times they jump. So the AFM examiner will give you a rate which is not on those tables at times. So if he gives us a rate which is not on those tables, what do we do? Then we have to remember the formula. But fortunately, the formula here is really easy. The formula here is really easy. The PV formula here, I'm repeating again, the PV formula, present value interest factor formula, is 1 plus R raised to negative who? Raised to negative n. It's very easy. It's very easy. It's very easy. Right. So anytime in this case here you have, ladies and gentlemen, anytime you have a discounting rate, which in this case here is on your formula sheet, on your tables, which is on your tables there, don't try to tell the examiner that you know what, I'm the guru of financial management. Nasema ati uko na hinya. Ataanza kutumia formula. No. If the discounting rate is available in the tables, always read those figures very fast from the table. If the discounting rate is not among the ones given in the table, then I have to be forced to use this formula. Great. Now, ladies and gentlemen, let's come back here. Now we have what we call the discounting factors. So with these discounting factors, what do? We'll come and create a column here for present value. Present value, which in this case here means what? A discounted cash flows. Discounted cash flows. So discounted cash flows means what? That you are taking the cash flows that you're given here, multiplying them with their present value factors. Like now 10 times 0.909, this will give me 9.09. Discounted cash flows would rather capture them in 2 decimal places for simplicity. Discounting cash flows, we shall be capturing them, ladies and gentlemen, in form of what here? How many decimal places? 2 decimal places. From there, we take 15 times this. So 15 times this is just somebody 12.40, 12.40, 12.40, 12.40, 12.40. Thank you so much. How about the third one? The third one is this. The third one from Steve, we are getting 13.52, 13.52, 13.52. And then we have 19 times this, 19 times this, 19 times this, 19 times this gives us 12.98. Thank you so much. Now, given that we have our discounted cash flows, what do you think will be the next thing to be done? What do you think will be the next thing to be done? Now that we have our discounted cash flows are like terms. Discounted cash flows are like 2 brothers now. You put them together, you add for us to give us the total discounted cash flow. You add, you sum. So this plus this plus this plus this, please give me a figure to write here. It gives me 47.99. Thank you and thank you very much. 47.99. And this total discounted cash flow automatically becomes who? Becomes the value of the firm. When I look at my future cash flows, that I'm an investor, I would want to invest in this company. So I'll be able to get the historical cash flows. Using this historical cash flow, that I should be able to project now the future cash flows, and then I discount them. When I discount them, get all the cash flows that we have in terms of today's value, in terms of today, then I should be able to add them up to get the total discounted cash flows. And the total discounted cash flow becomes the value of the farm. So there is no way I'll pay more than 47.99 million to acquire RCM Online College. No way. So this becomes the maximum price payable. This becomes the maximum price payable. This becomes the maximum price payable. Now, with that background, ladies and gentlemen, I would want us straight away to go to our past papers. Our past papers. So again, a quick reminder. I would want to see whether they're able to remember what have we just said about our past papers. There is a link to our past papers that I would want to draw your attention to, you guys, that you need to get that link tomorrow at your workplace. I know you have never stolen from your employer, but now here I'm giving you the authority to go and steal from your employer tomorrow. So when you will be in your office tomorrow, ensure that you print all those papers from your office and then you bind them. You call them advanced financial management past papers, advanced financial management past papers, advanced financial management past papers. If you do that, then we shall be safe. We shall be safe. Then we shall be safe. Very good. Now, ladies and gentlemen, I would want us to go straight away to May 2016, question number 4, boy. May 2016, question number 4, boy. May 2016, question number 4, boy, is a classical question showing us how we will value an organization using the DCF method. Using the discounted cash flows method, discounted cash flows method, using the discounted cash flows method. Once, ladies and gentlemen, you get across, you come across that question very fast, tell me that you are ready by writing Y for yes. Yes, yes. So all of us, do we have access to this question? Let me write the question here. 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 It is, Wanjiko has not yet gotten it. Thank you very much, Wanjiko, for being bold. Thank you so much. So can somebody in this case here share that past paper in our 2 WhatsApp groups, in our 2 WhatsApp groups, in our 2 WhatsApp groups? Don't send them the link. They may not be able to know how to use the link immediately. You know, the link has got various ears, various paper settings. They may not be able to interpret now. That they shall interpret tomorrow. So today, please send them the paper itself. Send them the paper itself. You can even send a screenshot of the question. May 2014. No, May 2016. Question number 4, boy. Great. So remember, this is advanced financial management. This is not home science. When you get this kind of a question, ladies and gentlemen, always start by reading the requirement. The required. Oh, let me try to be nice. Let me try to be very nice here today. After all, most of the students that I have here, they haven't paid. If I'm very tough, they may not pay, right? Let me talk nicely. Let me talk nicely. Thank you very much. Anyway, ladies and gentlemen, such a question always start by reading the requirement. The requirement will guide you. So like now here, the required, they want us to give them the offer price for a company called Tiny Limited. So it means that these guys want me to do farm valuation. Our subtopic here is farm valuation. Farm valuation. So they want me to give them the offer price for Tiny Limited if Huge Limited were to value Tiny Limited on a forward price earnings multiple of 8 times. So this is method number 2. Method number 2. Method number 2 that you could try to use here is what we call the price earnings ratio technique. Please write it. The price earnings ratio technique. You can write this in full. Price over earnings. Price earnings ratio technique. Method number 2. Now, would you kindly, ladies and gentlemen, remind me the formula of getting PE ratio? Is there somebody who can remind Mwalimu the formula? The formula of getting PE ratio. PE ratio equals who? PE ratio equals who? PE ratio equals, these guys are giving me good things. These guys are giving me good things. I can see what Steve is telling me. I can see what Nancy is telling me. I can see Bill Awairimo. Please remember, in Zoom, you must talk. In Zoom, you must talk. If you want to pass this thing round 1, keep on talking. Hata kama unaongea uongo, utapita. Wewe so long as unaongea, hiyo ndio kitu ya maana. So long as unaongea, hiyo ndio kitu ya maana. Yes. So what they're telling me from the words here, PE, they're telling me that this will be price over earnings. Great. So price is market price per share, all over earnings per who? All over earnings per share. This is the formula. If I were you, ladies and gentlemen, I would write this formula and then I ensure that I use a yellow highlighter. I would want to have a yellow highlighter passing on top of these. Is there somebody who has stopped using yellow highlighters? Or rather, is there somebody in this case here who hates color yellow? For those that have ever taught before, ladies and gentlemen, I've always told you what here to use a yellow highlighter. Don't politicize. Yellow, don't politicize. I started using yellow highlighters. Actually, during physical class, I used to buy my students here yellow highlighters because yellow brings it out very well. Don't bring politics here, really. Don't bring politics here, really. No. So whichever then. So after you do this, now come and ask yourself, firm valuation. What do we mean with this firm valuation? You know, firm valuation starts from like an atom, the smallest. To value a firm, I would want to ascertain the market price of a share. The market price of a share. So could you kindly make MPS the subject of the formula? Make MPS the subject. Make MPS the subject of the formula. Why am I making MPS the subject of the formula? It is because I want to get value of one share. The moment I get value of a share, I will have known the value of the company. Like right now, ladies and gentlemen, let me ask you a simple question. I'm sorry for digressing a little bit. What is the current market price per share of Safaricom? What is the current MPS, the current market price of a share of Safaricom? Somebody who looks at TVs, the TV stations that matter. I'm so sure most of us also like, no idea. The biggest company in the South, East Africa. You're not following in this case here, it's a metrics. You guys are not serious. No, I'm joking. Around 40, 50, no. 50 bado. 50, it would have hit 50 if the Ethiopian thing in this case here succeeded right away. But remember, they went to Ethiopia and then we had some turbulence, political turbulence in Ethiopia. Jackie is telling us that it's about 32. It's about 40. So the MPS of Safaricom is about 40 per share, shillings, 40 per share. Now, is there somebody who knows what the total number of ordinary shares of Safaricom are? Number of ordinary shares of Safaricom. How many shares does Safaricom have in total? Don't worry, I'll give you the answer. It's 40 billion. Now, so if somebody wants you today to give them the total value of Safaricom, if somebody wants you to give them, if somebody wants us to give them the total value of Safaricom, the total market value of Safaricom, the total market value of Safaricom, the total market value of Safaricom, how will you get it using these two parameters? You know the value of one share and you know the number of shares. So basically you'll talk over 40, which is the price per share, times 40 billion. 40 times 40 billion gives me how much in terms of trillion? In terms of trillion? How are they getting 2.6? I don't know. Right? Right. In terms of trillion, it should be about 1.6 trillion, isn't it? 1.6 trillion. And this is a figure that is really scaring everybody. Because even if you were to add, for example, the blue chip companies at the stock exchange, add their total value, all the other blue chip companies, add their total, they can't come to this Safaricom's value, close to Safaricom's value. So people are trying to ask themselves, remember Safaricom really, in terms of assets, it can't be bigger than KCB. It can't be bigger than 𝐿𝐿. It can't be bigger than EABL, right? Unless you're looking at the intangible asset, which is goodwill that Safaricom has, right? So the thing is, which I wanted to sell to you here today, to get total value of a firm, you shall be taking market price per share times the nose. Remember that this is also called market capitalization. Total market value of a firm is also known as market capitalization. So next time, if CIFA was to give me a chance of setting an exam, of course they can't give me, I'll give you price of a share, I'll give you number of ordinary shares, and then in the requirement, I'll ask you to compute the market capitalization of the company. The market capital. Market capital is the same as what here? The market value of the firm. And how do we get market value of a firm? You take the market price per share times the number of ordinary shares. Very interesting. Very interesting. So ladies and gentlemen, could you kindly make MPS the subject of the formula here? If you try making MPS the subject of the formula, to get MPS as the subject, it means a cross multiply. And if I cross multiply, I'll end up getting here the PE ratio times EPS. So this is market price per share. Market price per share is PE ratio times EPS. Now listen, this is value of one share. Now what if they want the total market value out of these? What if they want the total market value? To get the total market value, I'll take the PE ratio of the company. I will take the PE ratio of the company times, these earnings per share. But now I want total earnings. So times total earnings times total earnings. This is the formula that I came to sell to you here today. So after you write this formula, I would want you to highlight it in whichever color that you guys are comfortable with. Whichever color that you guys are so comfortable with. Green. I don't know why you've chosen green. Perhaps you don't even have a highlighter. Quite unfortunate. We must have a highlighter because these are the things that I would want when you open your notes. They're those things I would want to really hit your eyes first. When you are just perusing through your notes, the things that I say you highlight, those are really the key things for me. So if you have a highlighter that really comes out conspicuously to you, the better, the better. Myself, political affiliations notwithstanding, ladies and gentlemen, I'll always go for a yellow highlighter, Great. So what are we learning here today? What you're learning today, ladies and gentlemen, is very easy. I should be able to reflect this deeply. The total market value of a firm using the PE ratio method. I'll take the PE ratio of the firm times the total earnings. Now listen, I would want to repeat this again. But if, for example, you were to call me as your consultant in terms of valuing your organization for purposes of mergers and acquisitions, and then you tell me what they would want you to use a quicker way to give us an approximate value of the firm, I'll ask for two parameters. I would want to know what your average PE ratio is. Maybe you could have had other PE ratios over the years, so I'll average it. So I'll take the average PE ratio that your firm has times the total earnings. So I'll ask you for two parameters. I'll ask you for the PE ratio of the firm vis-a-vis who? Vis-a-vis the total earnings. That is so critical for me. I was reading this, and then I decided to do this as the second method. So before I read number 2 and number 3 under the requirement, I would want us to take this opportunity to read the entire question from the beginning. Huge Limited intends to take over Tiny Limited. Huge Limited intends to take over Tiny Limited. Quite bad. Another company in the same industry, Tiny Limited, is expected to post earnings of 86 million next year. Could you kindly underline for me the words earnings of 86 million? Because for firm valuation, that earnings is going to be very important to me. I'm an expert of mergers and acquisitions, and I know the earnings of a firm is an important metric. If Huge Limited acquires Tiny Limited, the expected results of Tiny Limited for the next years will be as follows. They've given us things there. I can see things there. I don't want to read anything from that table for now. From year 4 onwards, it is expected that the annual cash flow from Tiny Limited will increase by 4% each year into perpetuity. I don't want to hear that, right? Actually, even the third paragraph tax is useless for me. I'll go back and read requirement number 1. So requirement number 1, they want me to give them the offer price for this company if Huge Limited were to value Tiny Limited on a forward futuristic price earnings multiple of 8 times. So what do they want me to give them? They want me to give them the offer price. So I'll write here offer price, and then I'll be able to tell them that offer price is the same as market value of a company. And if it is PE ratio that they would want us to use, then I know the formula of getting market value using the PE ratio method. I know for sure that my market value will be the PE ratio that the examiner has given me times what, ladies and gentlemen, as a quick reminder, what should I put there? So I should take PE. I can see somebody who is trying to look at their notes. I can see somebody who does not want really to make their times total earnings. Thank you so much. Thank you so much. Times total earnings. So remember, the total earnings that were given there are futuristic. Forward ever, backward never, forward figures, forward, it doesn't matter really. What we need to know is, in this question, have they given us the PE ratio of Tiny Limited? Doesn't matter which name they use, forward, PE ratio, backward, doesn't matter. Have they given us the PE ratio of Tiny Limited? Yes. How much? How much? How much? How much? PE ratio from Roman number 1. It's 8 times. It's 8 times. Then, ladies and gentlemen, if you get a crazy examiner, like I can tell you myself, those days when I used to be younger, right now I'm no longer young anymore. When I used to be younger, I used to disturb students quite a lot. What I would do, I'll give you the total earnings of the Predator company. I'll give you the total earnings of Huge. I'll also give you the total earnings of Tiny. And then, of course, ask you to get the market value of Tiny. You'll get like a third of the students picking the total earnings of Huge company, right? And then they call me very fast. Most of them like calling me very fast, pick up very fast. Hi, the exam was nice. This time around, Molly, I'm going to pass. Molly, pass, and I'll buy you something. Great. When results come, and then, of course, in this case here, what will they tell you always? That they have been bewitched. There is nothing like being bewitched in this country. I'm changing my batteries. Just give me a moment. One moment. Pick. We should always pick the total earnings of the company we are valuing. Always pick the total earnings of the company that you're valuing. Great. Ladies and gentlemen, if you look at this, required, they wanted us to give them the offer price for Tiny Limited. They want to be acquired. And this Tiny Limited, they want to be acquired. If you look at paragraph number 1, that is where they gave us the earnings of Tiny Limited. Earnings of Tiny Limited. They want to be acquired. Is there somebody who can, I told you even to underline that total earnings figure. The figure, ladies and gentlemen, if I'm not wrong, the figure is 86 million. So if you take 8 times 86 million, what are we getting? Somebody 8 times 86 million? 8 times 86 million is 688 million. So this is the farm value using the PE ratio method. Farm value using the PE ratio method. Using the PE ratio method, this is the amount I'll give. So there is no way. So this becomes the maximum price of the company. This is the price you're going to offer. You tell these guys, you know what? We're offering you 688 million for all the shares of Tiny Limited. And then you guys walk away. Walk away. Thank you so much. So this really, there is nothing much to emphasize here. The most important thing that I would want all of us again to write here is that whenever they give us PE ratio and they want us to give them, ladies and gentlemen, the market value, then the thing that I should do is to multiply the PE ratio with the total earnings to be able to get the market value of the firm. Are we comfortable with this? 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 Yes, a good question there. Are we not supposed to discount earnings? I've never seen earnings being discounted anywhere in my life. Never. Never. You can't discount earnings. When you start discounting, then automatically you are using the discounted cash flow method, which will be my second method here in Roman 2. Roman 2, they want us to give them Roman 2, not 2. Okay, Roman 2. They want us to give them the weighted average cost of capital for Huge Limited after acquiring Tiny Limited. I haven't taught you this, but you see, the good thing with AFM is that they always tell us that we are dealing with very bright students. Is there any student here who is not bright? Is there any student here who is not bright? Is there a student here who is not bright? They always tell us that, you know what, you're dealing with very bright students who have done this paper severally, either in the CPA streams or in the university, So that if you mention something, even if they have never heard of it, they'll be able to connect very fast. Like here, they want us to calculate what we call WACC, what we call WACC. WACC in full stands for weighted average cost of capital. Write it that way. Weighted average cost of capital. That is what they want us to get. So weighted average cost of capital, how do we get weighted average cost of capital? This is quite easy, right? Remember, we have got various components of capital. We have the cost of equity, we have the cost of debt in most cases, and of course the preference. Here we have only debt and equity. So because it is weighted, then I'll talk of the weight of equity multiplied by cost of equity plus weight of debt multiplied by cost of debt. But remember, cost of debt must be after what? It must be after taxation. The cost of debt must always be after taxation. Ladies and gentlemen, could you kindly write this in full and have a yellow highlighter passing on top of this? These are very important formula. These are very important formula. Very important formula. This means what here? The tax adjustment, 1 minus tax. Now, ladies and gentlemen, listen here. So when we talk of this WE, WE means weight of who? Weight of equity. Weight of equity. We have Kenya. This stands for cost of who? Cost of equity. And then we have WD. WD stands for weight of who? Weight of debt. Weight of debt. And then we have KD. KD is cost of who? Cost of debt. Lastly, we have the T there standing for taxation. The moment you write this, please let me know by you putting thumbs up. There is a place there where you can always use emojis. And in this class, I would really want us to be using emojis often. Emoji comes from the word emoticon. 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 For those of you who went to very good high schools and the ones that we went through, you know that emoticon is another term for another word for what here? For emotion. So please always try to show various emotions. Like when you see the concept sinking in very well, just try to look for a smiling face. Smiling face. When you, no, I would want to draw this smiling face. Yeah, look for a smiling face, and then you smile like that. Yeah, you smile like that nicely. Smile nicely, like that. And then, of course, when you're not able to understand even nothing, when you're not able to understand even nothing, please, there is also a sad face, a very sad face there, like this. A very sad face. Please, you pick on it, and then I'll be able to see from here. There is even a face which cries. There's a crying face. We must know how to use these emotions to make this like a real live class. You know, as I told you during the day, ladies and gentlemen, even when I'm invigilating exams, I look at some people there, beautiful ladies and some young men. You know, a young man, ameona question ambayo anajua sana, utamwona amesmile. So they keep on having, in this case here, moods that are really swinging, changing. Mara amesmile, mara imefika time nyingine unamwona amekasirika, swali imekataa kuingia. Yeye anasoma swali, anauliza hii swali ni advanced FM ama ni home science. Sasa anakasirika yake yo, tena kidogo anarudi amesmile kidogo. Right? Itakuwa international disaster, which is life. So we must really know how to use emotions. Emotions. Because you know, at times, typing, yes. Kama unataka kuuliza swali, wewe ndio usingoje kuuliza, wewe tafuta kimtu kinalia hapo, kama hiyo sasa hiyo. Weka machozi yote hapo. Mimi nitaona mara moja. Inakuwa very easy for us to navigate around. So now they are telling me, mwalimu, you know what? Now we are comfortable with this. Now, ladies and gentlemen, this is very interesting now. So I would want to look for these things now. This is very interesting. I would want us to look at the second paragraph. The second paragraph before required, second last paragraph before required. Is Lucy crying, or what is she doing, Lucy? What is Lucy doing? Let me look for Lucy here. Kama uoni vizuri unaweka hiyo miwani Yes, kama uoni vizuri. Like yeah, for example, very good. Kama for example camera, una kama camera haiko sawa, unaweka hiyo unasema I can't see clearly. Yeah, we should stop using a lot of words. So second last paragraph inasema, if Huge Limited acquires Tiny Limited, it estimates that the gearing after the acquisition will be 35%. I love this, gearing. Now, gearing. Ukisikia jina gearing in finance, niambia tumesikia ni gear ya gari. Hata siku hizi hakuna kuweka magia namna hiyo. Siku hizi gari ni automatic. Lakini ukisikia gearing, what comes to your mind? Great. I have bright students, yes. So gearing, ukisikia gearing ratio, hii ni sawa na debt ratio. Na hii ni sawa na weight of debt. Weight of debt. Weight of debt. So please write those three and have either a ruler passing below or, ladies and gentlemen, have a yellow highlighter. Gearing ratio is the same as the debt ratio, is the same as the weight of what here? Weight of debt. And there is a lady that I love there. Anaitwa 𝐿𝐴𝐿ice amesema leverage. I've seen the examiner using leverage ratio. Leverage ratio ni sawa na gearing ratio. Leverage ratio. Nakwambia 𝐿𝐴𝐿ice, kama si vile tu mwezi kokona, aki ungekula 2,000 kwa M-Pesa. Ni mwezi tu kokona, nisamee. Ungepata tu M-Pesa straight away because amejua leverage ni sawa na gearing. Kitu ni mwezi katikati tarehe 15, exactly katikati. Right? Mwisho wa mwezi nitakumbuka kutumia. Right? Of which these guys have told us that the weight of debt is 35%. Is there anybody who is able to see where we are getting this 35% from? Is there somebody? Lagat wewe ushindwe. Lagat ataka kuumiza boy child. Sema toa ile iko. We. You can't be a good chairman or men's conference. Are you able to see the weight of debt 35% given there? Aki hawaoni. Wametuambia kwamba these guys are estimating their gearing. And we have discovered that gearing is the same as what here, somebody? Gearing is the same as weight of debt, which is 35%. Thank you very much. So having gotten weight of debt as 35%, what do you think in this case will be the next parameter to get? What do you think will be the next parameter for us to get? What do you think will be the next parameter for us to get? Great, the equity. The moment we know debt, then we'll easily get equity. So then weight of equity, can I go to mass and pick it? No. I know weight of debt plus weight of equity must be wholesome, must be a unit. Both of them must add up to 1. So I know that weight of equity will be 1 minus 0.35, which will end up giving me point what here, somebody? 0.65. 0.65. Ukiona the way we mark AFM, we are normally very fair. Very fair. Ukiona umeanguka AFM for sure, you deserve to fail. Hata pass mark ya AFM, hata yesifika 40%. Na wao tunaangalia, kama hapo utapata tumeandika, tunamark hivi, tunaweka hivi. Hiyo ni half a mark, 0.5. Right? We are normally very, very fair. So ukiona umeanguka AFM, wewe usiblame anybody. Chance, alafu najua ukichukua sasa hii kidogo, unakuja kama hata la semester theory, tunasema theory taka ameandika dog is a dog, mpatie namna hii. We are very generous in marking these papers, very generous. So ukiona umeanguka, please don't blame anybody. Don't blame anybody. Nisiongezee chumvi. Angalia hawa sasa. Tusome tu. Sawa. So leverage na weight hiyo tumepata tayari. Haya, hebu angalieni hapa. Sasa tunaenda kwa angle mzuri sana. Okay, sasa kidogo haijapona. Pole, we shall overcome. Tusome kwa amani. Sasa I know the next thing. The next thing these guys would want me to, they can't give you this thing. In AFM, it will be very hard for them to give you this thing, this cost of equity. So kuna njia mbili za kutafuta cost of equity. Iko mwenye anazijua hizo njia mbili za kutafuta cost of equity. Kuna njia mbili ambayo ulifunzwa katika financial management, very good. Kama Jackie amesema CAPM is one of those ways. You could try to use CAPM. So allow me to teach you how to get cost of equity using the famous CAPM. Remember, CAPM stands for capital assets. Capital assets pricing model. Very easy model. And we normally say that CAPM, cost of equity. I may forget about Hamada's model. No, Hamada's model doesn't apply here. I'll tell you when Hamada's model applies. That tells me, Felicitas, you never knew how to use Hamada's model in last semester's exam. It was there. You never knew how to use Hamada's model, and you never tackled the Black-Scholes equation nicely. You know, if you missed on the Hamada's model, you missed on the Black-Scholes model, then you failed automatically. Those were the low-hanging fruits. You know, when you go to Kitui, right? You'll get very good, ladies and gentlemen, very good fruits over there. There are those fruits out of the ground already. And yet you don't even need to harvest them, right? No, you is ground. Is it your low-hanging? After they're not even hanging, they're already on the ground. So if you're not able to pick them, then those ones which are up there, you can never get them. Right? You can never get them. Right? Right? So CAPM cost of equity, I may forget about all things, but I'll never forget about the risk-free. We must start with the risk-free rate of return. We must start with the risk-free rate of return. Plus, into brackets here, we have expected returns of the market minus risk-free, multiplied by beta equity outside here, multiplied by beta equity. So we write this in full for the sake of the students who are just joining us from last semester. They were in the intermediate level. They need to have this thing in full, but they learned this. They learned this. So this RF stands for what here? Stands for risk-free rate of return. Risk-free rate of return, right? Thank you very much. Then we have ERM. ERM stands for expected returns of market. Expected returns of market. And then we have BE standing for beta who? Beta equity. Beta equity, because they want us to give them the cost of who? The cost of equity. The cost of equity. So let me ask you a question. Have you guys been able to write this nicely? I'm not asking whether you've understood it. Nimeandika chini sana leo. Nimeandika chini sana. I know what I'm going to do is just to I hope they'll be able to see up to there. I hope they'll be able to see my screen. I hope they're able to see my board. I hope they're able to see my board. Thank you so much. Now, ladies and gentlemen, trust you me. There is no way this advanced financial management examiner can ever set questions and exam without bringing CAPM. CAPM has to be there. So let's read the question. Let's read this question here. Let's read this question here. The second last paragraph. Second last paragraph before required. Before required. We are told if Huge Limited acquires Tiny Limited, it estimates that the gearing after the acquisition will be 35%, measured as the value of debt as a proportion of the total equity and debt. After the acquisition of Tiny Limited, Huge Limited would have a cost of debt of 7.4% before tax and a beta of 1.6. And then they have given us the risk-free rate of return, which is 6, and the return on the market portfolio is 11. There are things, ladies and gentlemen, when I look at them, I'll be able to know that this examiner wants me to use CAPM. CAPM. When I see risk-free, when I'm seeing returns of the market, when I'm seeing beta something somewhere there, I know for sure that this examiner wants us to use, he wants us to use CAPM. Now, let me ask you a question. Is there a student there who is able to see the risk-free rate of return? Is there a student who is able to see the risk-free rate of return? Risk-free rate of return? Risk-free rate of return. Tony Mbudi anasema 6%. Thank you very much. Thank you very much. How about market returns? How about market returns? Are you able to see the market returns? Wanasema 11%. 11%. Thank you so much. Minus risk-free again. Risk-free is 6%. And this examiner was quite an easy examiner. Why? Because he gave me beta. He never specified. If he doesn't specify, I don't adjust at all. He gave me beta. 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 I don't know whether I should be pronouncing it as beta or beta. No, it's this beta. It is this beta, not beta. So wanasema ni 1.6. During the day, I gave you 3 reasons that makes students of AFM flop always. And one of them, it's because of what here, they are not so good with body mass. And I gave you secrets of knowing how to work with body mass very well. Yes. Come up a body mass, of course, I can see brackets. So first of all, I'll say 11 minus 6. Whatever I get, I can see multiplication. I multiply first. Whatever now answer I get out of this, I'll come and say plus what here? Plus 6. Jackie tells me 14%. Jackie tells me 14%. If you want to fail in your exam, you ensure that whenever we get these figures, you always copy them, that your work is being very good in copying them. Don't do that. Punch this in your calculator. If you're not able to get this from your calculator, please put up your hand. There's a place of putting up your hand. Tell us, hey, you must slow down a little bit and show us this thing. So cost of equity, I'm being given there 14%. 14%. 14%. 14%. Thank you, and thank you so much. Thank you, and thank you so much. Now I think we have everything which will be able to assist us to get this thing that some student here pronounced very badly the other time. Some student told me that I should be pronouncing this as wakaka. Okay, well, perhaps for the sake of having it implanted in our minds forever, wakaka may seem nice. But now, do we have the weight of equity? Do we have the weight of equity in this question? Do we have the weight of equity in this question? Do we have the weight of equity? They are forgotten, you see now. You see now they are forgotten. 35%. Is it 35 or 65? 65.65. Thank you so much. The cost of equity, you guys have given it to me, is 14%. And then we have weight of debt. Weight of debt, ladies and gentlemen, weight of debt, the two must add up to 1. Weight of debt is 0.35. What I know that most of us will not be able to see very clearly with their 2 eyes is the cost of debt. The cost of debt. Are you able to see the cost of debt somewhere? Are you able to see the cost of debt somewhere in this question, in those 2 paragraphs before? Sharon, thank you very much for saying no. I can see cost of debt somewhere there. Before, second last paragraph, last sentence of that paragraph. After the acquisition of Tiny Limited, Huge Limited will have a cost of debt. Cost of debt is KD. Cost of debt is KD. Cost of debt is KD. So then we come back here, multiply by this cost of debt, which is 7.4%. But now you must be very bright. At times they tell us the cost of debt is after tax. If the cost of debt is after tax, we don't apply this tax adjustment rate. If they told you that this is a KDA like that vehicle you're driving, number plate is KDA. KDA. But gari ni about maintenance really. Great. Now listen and listen to me very well. Wakisema ni KDA, cost of debt after tax, we don't apply this. Wakisema ni cost of debt before. So you have to be careful this examiner not to cheat you. So this KD, is it KD before? Is it KDB or KDA? Is it KDB? Is it cost of debt before or cost of debt after? Which cost of debt is this? It's KDB. It's cost of debt before. They always tell you it's cost of debt before. It's cost of debt before. So times 7. So if it's before, then I must come and multiply here with the tax adjustment, the tax adjustment rate, which is 0.7. They don't even know where I've gotten 0.7 from. They don't know. They don't know. They don't know where I've gotten the 0.7 from. They don't know. Do they know really? Do they know really? Do they know where I've gotten? Yes. They're saying yes. They have seen tax is 30% given up there. Tax is 30%. And if it's 30%, then I'll talk of 1 minus 0.3. I'll talk of 1 minus 0.3, which will give me 0.7. So all students are having their fingers working on their calculators. I expect you guys now to give me wakaka. I expect you guys to give me wakaka. They're telling me that this wakaka is 10.9 something percent, which is the same as what here? I will use 11% for purposes of my discounting. 11% for purpose of my discounting. Thank you, Susan. Thank you, Lucy. Great, great. So are we together as pertains Wakaka? Are we together? Are we together? Are we together? Are we together? Thank you so much. Great. So number 2, that has been taken care of very well. Now, I gave you a story here. When we started this Wakaka thing, I told you that this cost of equity, we've got 2 ways of getting cost of equity. Remember, we've got 2 ways of getting cost of equity, 2 ways. I'll never forget this. To get, okay, there are many ways, but the ones that are very popular with my examiner are 2. We have Kapoom, and then we have what we call the provincial officer. Provincial, I love this provincial officer, PO. Provincial officer, PO. Nyi mnajua kweli kutafuta, na anajua formula ya PO hapa, na anajua formula ya PO woye, na anajua formula ya PO, na anajua formula ya PO, provincial officer, na ameshasikia formula mahali. Hebu iandike chini tuone. Hebu iandike chini tuone. Provincial officer, I really love provincial officer, because also you'll never pass advanced financial management if you don't understand my provincial officer. If you don't understand my provincial, thank you so much. Thank you so much. I can see somebody who has told us that provincial officer equals district officer who has to grow in rank. We must allow him to grow. We must allow him to grow. And then all over Kenya, without a government, like the way things now, the way things are standing right now, we really don't have a government. You can imagine a government where the president and the deputy president don't see eye to eye. So Kenya minus who? Government. They should not hear me. Kenya minus government. Now don't take that thing so seriously. Otherwise, we know, these are very important formula. Very important formula. We know that PO is the current market price per share. We know that DO is the current dividend per share. We know that KE is the cost of equity, is the cost of equity. We know that G is the growth rate. G is the growth rate. But now remember that this time round, I really wanted to show you how to calculate cost of equity using provincial officer. So then how do we get to calculate cost of equity using, could you kindly try making cost of equity the subject of the formula? Make KE the subject of the formula. 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 You say somebody will be able to try to do that for me. Remember, I'm using this topic here to lay a very important base for very many other things which are ahead of us. This is a very important topic. You will see the moment I've covered this, when I go to financing decisions, everything will be falling in place. I'll simply be mentioning, do you remember provincial officer? Oh, yes. Write down, make KE the subject of the formula. So if I try making KE the subject of the formula here, ladies and gentlemen, if I try making KE the subject of the formula here, what am I going to have at the end of the day? This is what I shall have at the end of the day. My PO times KE minus G, because I've cross multiplied, will be equal to DO into 1 plus G. Then what I'll do is to come and treat this as one number. And then I divide both sides with PO. Divide both sides with PO, like that. So this and this will cancel out. And then now I'll come and take this G to the other side. This is like a River Jordan. This is like River Jordan, right? River Jordan here with so many crocodiles. We expect that when you cross over, you go to the other side, things must change. You cannot, in this case here, cross the other side, ladies and gentlemen, and then things remain the same. No. So we expect, ladies and gentlemen, when this G goes to the other side, it has to change a sign. So on the other side, it will be DO into 1 plus G all over PO plus what here? This G goes to the other side and it becomes plus G like that. Thank you very much, Susan. This is so great. It can't just go like that without a yellow highlighter. must apply a yellow highlighter on top. And if you don't have one, please, we should organize a buy for you. One. It has to be yellow. If I'm the one buying you, it has to be yellow. Political, but don't bring politics here. Yeah. Because you can imagine, like now you have a highlighter, which is it violet or indigo or which one? Those are very useless. They can't highlight nothing. Mukamba. Wewe ni mnini? Wewe unaleta ukabila, balkanization using ukabila. Wewe ni kabila gani wewe? Wewe ni kabila gani? So this is so important. This is so Kenyan, yes. So don't call others Wakamba. All of us are Kenyans. Great. So this is a very important formula. And you know, as a good student, when I read my question through, I should be able to know which formula to use. If, for example, I go and read a question and realize they're giving me market price per share, they're giving me dividends there, they're giving me a growth rate, I'll know that these guys want, or they want me to make use of what here? KE. It's called dividend evaluation pricing model. Dividend evaluation pricing model. But these are things that will become clearer as we get along. As we get along, some of these things will be able to come clearer. But at least for now, if I was to end this class here, I want to believe that our great students of financial management will have understood that for the sake of AFM, I will always be thinking about what your cost of equity CAPM or this dividend evaluation approach, the provincial officer approach. I don't have to recall the derivation. No, I'll only be required to memorize what I've told you guys to highlight. But those will come in later. So can I continue with my question, ladies and gentlemen? Can I continue with my question? Yes. So what have they told us there in number 3? They want us to give them the offer price for Tiny Limited using a discounted cash flow based valuation method. Thank you so much. Now, ladies and gentlemen, I would want us to have some good illustration here. Great illustration here. Assuming we have Abdul Limited. So Abdul Limited, in this case here, has made some great investment. And Abdul will be getting 10 million Kenya shillings per annum for 5 years. And then we have R is 10%. Could you kindly, required here, determine the present value, the total present value of Abdul Limited? I hope they're able to understand this. And Abdul has made some investment, and Abdul Limited will be getting 10 million Kenya shillings every year for how many years? 5 years. For 5 years. And the R is what here? R is 10%. Remember, now we are tackling Roman 3 actually. Roman 3, but I'll have to do a little illustrations before I tackle that question. Susan tells me that this gentleman will get 6.2090. Poor Susan, today you've let me down. Susan. That answer is not correct, Susan. You can imagine. That answer is not correct. You can imagine. That answer is not correct. 37. Right. Great. So what these guys have been able to know, ladies and gentlemen, is this fact. What they've been able to know is this fact, that this is an annuity. And if it is an annuity, then I have to use what we call PVFA for present valuation. For present valuation, I must use PVFA. I like what Edwin is telling me. use annuity formula. Thank you very much. Thank you very much. Now, before I show you how we are going to calculate PVIF, could you kindly, in this case, ladies and gentlemen, give me the formula of PVIF? Could you kindly give me the formula of PVIF? Remind me the formula of PVIF. How do we get PVIF? Somebody, 1. I like what Atieno is doing. Atieno started by giving me 1. Thank you so much. I love students who keep on, in this case, you're trying. Thank you very much, user. User is telling me, Mwalimu, that is the easiest formula. I'll come and use here 1 plus R raised to negative n. Thank you so much. This is PVIF, and we normally use PVIF for irregular cash flows. Thank you so much. So then, how about PVIF? I love PVIF as well, because to get PVIF, we normally take 1 minus the smaller formula. 1 minus the smaller formula. So 1 minus 1 plus R raised to negative n all over R. Everything to be divided by R. So anytime they tell us to use PVIF anywhere, PVIF stands for present value interest factor over annuity. When they want us to calculate present value interest of an factor, present value interest factor of an annuity, I'll always remember one thing. I'll take 1 minus the simpler formula, 1 minus the PV formula, and then everything. Here I'm talking to you, ladies. You'll get some great ladies. I've never understood this really. How you'll get very many ladies. I've never understood this really. Very many ladies. I've never understood this really. Very many of them. Anakujanga hapa na divide hapa na R peke yake. Ana make nini? 1 ikiwa independent. Ananyoroshwa. Anasema mwalimu unaonea ladies sana. Hapana. Just remember, it is all over. It is all over. It is all over. Everything divided all over. So then in this question, is there somebody who is able to plug in this question? What do we have? So we'll have here 1 minus. Hebu jaribu plug in kitu ya Abdul. Question ya Abdul. Tunaota plug in utapata nini? So 1 minus 1 minus 1 minus 1 minus 1 minus. You see the area is 10%. Kwa hivyo itakuwa woye 1 plus 10%, which is the same as 0.1 raised to negative number of years. And the number of years in the questionnaire, there are 5. There are 5. And then you come and divide this by R, which is 0.1. So remember now here you have to go slowly. Ile mwendo wa aste kama wa kinyonga. Upate numerator. Kumbuka kwa calculator yako, kuna kitu ambayo inakaa namna hii. Kuna kitu ambayo inakaa namna hii kwa calculator yako. Raised to. Kuna kitu ambayo inakaa namna hii raised to kwa calculator yako. So nasema 1 minus 1.1 raised to negative 5. Raised to negative 5. Alafu unasema equals. Unasema divide kwanza. Unasema equals kwanza. Whatever you get, then you come and divide it with 0.1. Whatever you get, you divide with 0.1. Babu Ram. You have a very good name, Babu Ram. 3.7908. 3.7908. 3.7908. 3.7908. So all of us, are we able to get these figures, ladies and gentlemen? Please. All of us, are we able to get this figure? All of us? They are not talking to me. They're not talking to me. Great. Yes. Thank you very much. Abel, you have really known this thing. Great. The only thing that I would want you, Abel, to try to use always, remember when you are doing like this, kuna mkono ya mzungu, kuna mkono ya mzungu, na kuna mkono ya Mwafrika. Always tunaweka mkono ya Mwafrika. Tunaweka mkono ya Mwafrika. Thank you so much. 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 Now, ladies and gentlemen, listen here. Listen here. Therefore, the total present value of Abdul's cash flow will be the 10 million is getting here every year times the PVIF. Times the PVIF. 10 million times the PVIF. So then this will be 10 million times the PVIF that you got here of 3.7908. right? George is saying RCM is international, so it should be allowed to use. So this will give me 37.908 million Kenya shillings. Kenya shillings. Are we together up to here? 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 Great. And for your information, you guys, none of us has asked Mwalimu a question. None of you has asked me a question. So there are two possibilities. Either you are not understanding totally, which of course I'll tend to disagree because I can see so many yeses being given to me there as a sign of affirmation that really we are understanding. So two things. Either you are not getting totally, or number two, this semester I've been lucky to get a group of geniuses. So I don't know which one to believe, but somebody has told me, Mwalimu, it is flowing. Thank you so much. It is flowing. It is flowing. It's flowing. Now, kutoka hapo sasa, tuangalie hapa msichana mmoja. Msichana mmoja mwenye akona bahati kama ya mtende. Msichana mmoja mwenye akona bahati kama ya mtende hapa ni Anne Mwaura. Assuming Anne Mwaura, perhaps Anne, you could be married, you'll forgive me for this, gets married to a CEO of Safaricom. The CEO of Safaricom, in this case here, Bob Kolimo, late Bob Kolimo, may his soul rest in peace. This gentleman, akuachie sasa namna hii Anne, right? Akikuachia hii amekuambia 10 million, utakuwa na earn 10 million from this fund. 10 million per annum, right? And the R is 5% this time round. Lakini anakuambia utakula paka ukue mshosho 100%, hata ukitaka kuachia mwingine. Yani anakuambia this 10 million will be received to you and your generations every year indefinitely. 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 And then now you are required here for you to get married to him. You are required here to calculate the total present value for you to get married to him. This is the only trick. 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 Once you get that correctly, you get a husband. Good husband for that matter. Those husbands who are earning 10 million shillings per month. You don't need to work, imagine. These guys wameniambia mwalimu, this is very easy. This is very easy. Wameniambia mwalimu, we know one fact. We know that this is an annuity thing. And if it's an annuity thing, then I'm going to use PVFA. And if it's PVFA, it's going to be 1 minus 1 plus R raised to negative n, and then everything to be divided by who? To be divided by R. And then one thing that I've loved about these students is the fact that they have known that this is going to be infinity. And if it's infinity, then the entire term will not be defined. Meaning that PVFA, when n is infinity, will always be given with this formula called 1 over what? 1 over R. So PVFA will always be given by 1 over R. This is something that I would want us to really box. If we don't love yellow, then I would want us to box this. They're saying my network bandwidth is low. Is it mine? Is it mine that is low or yours? Is it mine that is low or yours? Network mine. Yeah, don't worry. All of us will become so good. Even if you're coming from intermediate, I'm aware that there are even students who are exempted totally, but the speed I will take you with, slow speed, sure bet. So long as you promise me one thing, there is one thing I would want you to promise me, that whatever questions that we do here, you must always repeat them when you are out there on your own. Before you come back to the next class, you must always repeat all the questions that we do here. Always repeat them. Can you make that kind of a promise? Because at times it's embarrassing, like today in the afternoon, there is a student who came to me, akaniambia, mwalimu, I was in your class. How comes I failed again? Tukakaa naye tukaangalia paper, namuonyesha, nimwambia kuja na vitabu zako na video. Namwambia angalia question ya Hamada's model. Tulifanya a question like a day to the exam. Hamada kept on singing. Wanafunzi ambao walikuwa na nyia tunaweza kubali na mimi. Hamada, 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 Hamada. Right? The only question that I sang about so much, examiner can dodge. Ndio dodge saa zingine. Ni question ya money markets ambayo haiwezi ka miss this time round. So most of the students here were not able to see those questions because when mwalimu does these things, and this mwalimu jokes quite a lot, when I do these things here, you guys think they are very easy, right? Right? No, they can only be easy, ladies and gentlemen, when you are doing them on your own. If I'm doing them and you're gauging me to assess whether a question is easy or not, I've done this same thing for over 20 years, you can imagine. So if you want to know whether it's doable or not, always go and put kitabu kando, alafu unafanya namna gani? Unajaribu kuweka answer kando, unajaribu kufanya mwenyewe. Once you repeat the questions that I'm doing severally, and whatever videos that I give you, nikwambia angalia. Usione kama mimi ni mjinga. Angalia, utapita sana. Na usiwache spiles of video. Anza kuziona mapema. Na pia ikiwezekana, please, mwanze kuomba leave mapema. Ile wiki mbili ya mwisho ile ya July, before exam. Please ensure that you'll be able to get yourselves on your own reading time. You'll be able to get like those 2 weeks fully dedicated towards what here? Towards studying. Those 2 last weeks are very important for you. Start telling your boss today. Tell your boss, you know what? Come this particular time, I will be sick. If your boss is very bad, tell them that like that. I'll be sick for 2 weeks. And I'm very serious because we need that time to do what here to revise. Because ukiuliza kama mwanafunzi alitoka hapa kama ameshangaa sana, right? Sick. Wewe mueleze utakuwa sick. Sababu kuna saa wale mnaniambia kama last time. Wananiambia tu employer wangu hawezi nipatia leave. So what do you do? That's a bad employer who does not understand what we call continuous professional development of an employee. An employee should study leave. Lakini pia nyinyi kama ningekuwa nyinyi, when I'm doing this last advanced level, why do you want to push all your leave days to December to go and enjoy Christmas festivities which are nothing? The advanced level, try to break down your leave days into 3. If, for example, in a year you have 35 days in a year, break them. 12 days, month of April, as per your exam, 3 exams in a year. Break them like that. Right? Break them like that. Because you need the last 2 weeks for you to be able to, even when I point out to you, I tell you there is a Monday, you need to watch this. You need time. At that time, you can't serve very many masters. This is not a paper that you should go and fail 5 times. No, kwani umerogwa. Right? So we are saying here something very important, that PVFA, when n is infinity, is 1 over r. Thank you so much. Now, ladies and gentlemen, listen to me very well. Then what will be the total present value? So the total present value will be the annuity that you have here times this PVFA, which is 1 over r. We are getting something very nice. Total present value will be the annuity divided by r. And this is something else that I would want to sell to you today here. Total present value equals annuity divided by r. So in this case here, the annuity is 10 million. The annuity is 10 million divided by r, which is 5%, 0.05. So what is 10 million divided by 0.05? What is 10 million divided by 0.05? 200 million, like that. Ladies and gentlemen, I would want you to listen and listen to me very well. There is something that I would not want you guys to be deriving. No. I don't want you to be deriving some things. When you go to an exam and then you realize that an examiner tells you that there is some amount here that will be received every year in perpetuity. In perpetuity. Ukisikia something in perpetuity, infinity, or indefinitely, unajua hiyo ni present value when n is infinity. Hiyo inakuanga ni a all over r. The annuity all over r. This is so important. So important. So important. Now, we have in this case here, this CEO of Safaricom making this thing even better for this lady. She comes and tells this lady that, you know what, this amount will be growing. This amount will be growing at, for example, 2% per annum. So this amount has some growth rate. 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 And the growth rate is 2% per annum. Abracadabra. The growth rate is 2% per annum. So andika hapo growth rate. Andika hapo growth rate. Andika hapo growth rate. So what have we said? Yes, Sharon is telling me to repeat that when n is infinity, what do? You take the annuity amount, you divide by r. So like in this question here, what is the annuity amount? The annuity amount is 10. I'll be getting 10 every year. Divided by r, which is 0.05. That's how we were able to get that 200 million. Thank you very much, Sharon Mgongo. You're the first one to ask me a question. That's very good of you. Thank you so much. Perpetuity, indefinitely, infinity, the same. Perpetuity. Perpetuity. Infinity. Indefinitely. The same. So go ahead and write perpetuity with growth rate. Perpetuity with growth rate. Perpetuity with growth rate. So perpetuity with growth rate, this is what is going to happen. Our present value will be amount into the growth. We must add that growth rate there. So amount into 1 plus growth rate all over r minus g. All over r minus g. So whenever we have growth rate, if I were you, I would want to make very good notes. I would come and say, yeah, perpetuity with growth rate. Perpetuity with growth rate. Present value will be equal to the amount into 1 plus g all over r minus who? R minus d, R minus g. And this is a very important formula to us. Every time you hear perpetuity growth rate, I'll always be telling you, hey, perpetuity with a growth rate, always remember the PO formula, provincial officer formula. Perpetuity with a growth rate, always remember the provincial officer formula. It is BO into 1 plus G all over R minus who? R minus G. All over R minus G. Let me just lower my camera a little bit for you guys to write that nicely. Na nikaandika juu kidogo kwamba ukisikia swali na kuambia kwamba there is a perpetuity receivable which has got a growth rate, let me just write this somewhere up here, which has got a growth rate, I'll be saying that is provincial officer formula. It will be DO into 1 plus G all over R minus who? R minus G, like that. R minus G. Very important. This is very important, ladies and gentlemen. If you look at the question that we are doing here today, I would want you to look at the paragraph, the first paragraph coming after the table. The first paragraph coming after the table, when I say from year 4 onwards, are you able to see that paragraph which starts from year 4 onwards? From year 4 onwards, are you able to see that paragraph? No, they are not seeing that paragraph. After the table, after the table. Thank you so much. From year 4 onwards, it is expected that the annual cash flows from Tiny Limited will increase. Will increase, meaning there is a growth rate of 4% each year into what? Into perpetuity. Into perpetuity. So there is a growth rate compounded with what here? A perpetuity cash flow. So when we come to our next class, ladies and gentlemen, I'll be able to show you how to tackle that question using now this PO. So today, I've used today's session to lay a very important ground, very important ground, very important ground, very important ground, very important ground for our next class. Our next class. So it's important today, we have been having so many guests. It's important, ladies and gentlemen, that all these guests should be able to come and join us, isn't it? Should join us this semester, and we walk this journey together. This journey together. Very productive. Thank you very much. Thank you very much. So if you would want to make any inquiries, remember our number is 0719 525,000. That's our number. How much do we charge? There are those students who would want like Zoom classes only, Zoom only. So Zoom only, we charge 3,500. The students who would want, in this case here, Zoom, or rather videos only. Videos only, we charge 3,500. These videos are offline. Offline means you can watch them without internet. And then we have those students who would want Zoom plus videos. Zoom plus videos, we are charging 5,500. And the students who buy from us these Zoom plus videos, Zoom plus videos for 500. And there are students who are telling me, Mwalimu, this semester, as we are sharp, as in this case here, we are not, going to start things from, would want this time round, you create a class of repeaters. No, repeaters are not a very good term. Which term should I use really? I don't know. But they would want me to create a class which they are calling special revision. Special revision, where basically we do CASNEB questions and their answers like that. Right? Of which we have decided, ladies and gentlemen, to introduce special revision for 3 subjects. So we have AAA, we have AMA, and we have AFM, those 3 alone. And we shall be charging each paper for this particular class 5,500. 5,500. It's a special high-level revision class. If you need it, it has got to be quite expensive for you. For those 3 classes, like that. Don't sanitize. So remember this class, we agreed you guys must market these classes so that we get more than 100. Don't market the normal class for me. The normal class for me that I've done over years, I know I'll get more than 200. Hii normal class hii muko hii lazima ifike 200. Hiyo mimi nimezoea miaka mingi. Lakini hii especially lazima mtengeneze mwalimu, wanafunzi watoke all over wakuje attend kitu. The timetable, does it incorporate work class people? Yes, gladly. That's why we are studying here today, this time. Our classes are 8 p.m. to 10 p.m. And the next class will be on when? On Friday. Next class will be on Friday, 8 to 10. And please, this time around, I'll be giving you very few videos, which I expect you guys to watch before you come to the next class. So I'll send you 3 videos covering the next concepts I'll be teaching you, right? So it's my hope that you guys have enjoyed today's session and you're going to make an informed decision. You're going to make an informed decision to join our online community of learners. It is the best. It is the best. Kama saizi you can imagine, unamaliza namna hii class, unalala. Hawanzi kungangana mambo ya kutoka town na manini tena, manini, right? Kama unatoka for example Upper Hill na maybe unaishi Mombasa Road, si lazima kuja town kutoka college, unakamata unaenda vichochoro, unaenda nyumbani, right? So nasaidia hata nyinyi kuongeza mapenzi kati yenu na watoto wenu. You have time for family, right? So it is the way to go. This online learning is the way to go. Ile physical classes, class ikisha imeperish. Kama sasa hii nime-record, utapata recording almost not me tomorrow morning, because I'm rushing also home now. Tomorrow morning, right? So thank you so much. In case of anything, Gladys anauliza kama tuko na library. Sasa library wapi Gladys? Gladys sasa wewe. Ama niweke virtual library. We've got no physical presence. Maybe ununue ile vitabu zetu kama hii kitabu kama hii. Ununue kama hii. Asante. Gladys, this is a virtual college. This is a virtual college. No, we haven't covered a lot. We haven't covered a lot. And videos for topic 1, they are there. For topic 1, they are there. Yeah, Orlando Express. Buy books. Thank you very much. All the best. Good night. In case you would want to chat with your mwalimu kidogo, lakini mwalimu usipigie mwalimu simu sana. Kuchat na mwalimu kidogo tu. Maybe unataka kumtumia M-Pesa peke yake. Hii ndio my personal number. My personal number. Otherwise, thank you very much. Be blessed. Say hi to your family. Have you covered much on the revision? Revision, no, we are starting, Naomi. We are starting. Thanks. Thank you. And please keep all the promises. Hizi nitawajibu kwa WhatsApp sasa. Sababu nyumbani masaa ni mbaya, nataka kukimbia nyumbani. Tawajibu yote kwa WhatsApp. But the last thing I want to talk about is that you guys are bringing me students. Please, from all over, bring me students. Thank you very much. Bye.